All right, AJ. Our first name, I think a lot of people are very familiar with, and that is Bank of America, ticker symbol BAC.
Yeah, this one is on my radar because it just gave me a signal in the last couple of days, as you can see here. So if I kind of zoom into the last 3 months, you can see that just last night I got a signal and I'm looking to see if today's the day I want to either buy some of the Bank America stock or more than likely buy some substitute option like a call option that would behave. So I'm going to go deeper in the money and farther out in time. I'd like to aim for that trading at parity because Bank of America, if we zoom out a little bit, you can see that they're forming that path like where they've got tested support, tested resistance. They've got this oscillation that I need to leg into my gains. Right when I leg into a position, and everybody should take a note on this right now, that really changes a marginal gain position to like a supercharged position. And it kind of makes sense, right? Anytime we want to do buying, we want to buy low, and anytime we want to do selling, we want to sell high. So if you've got a two-leg option position, do the buying parts when the underlying symbol is low and do the selling parts when the underlying symbol is high, and that spread is going to change like a 3%, 4% returning position to something like a double digit return.
And you don't have any specific timelines, specific contracts. What does the option flow look like?
Sure. Yeah. Let's take a look. So I could, if I get my confirmation to this signal today, and if I don't get it today, I'll look again on Monday. I could just buy Bank of America stock, right? It's not so expensive. Right now, it's trading at $34.95 a share. And I'm going to buy them in lots of 100 shares because that then allows me to use my option strategies. So for 35 bucks, I'll need to have about $3,500 in my account. And that don't forget to factor in the expense of the risk. So if your account is only $3,500, it doesn't mean you can buy, you can afford this. You need to make sure that you evaluate the risk and that you can afford the risk. Okay, all disclaimers aside, I can buy, the stock, or, I want to have an option that kind of sticks around. And so I want to go far enough out in time. And I'm looking at the option series here. Man, they've got Bank of America is a very popular stock, and therefore it's also a very popular option chain. I'm kind of looking at this April or this June 2023 option. If I look at the April option looks like it just was made available to trade, and people haven't really quite picked up on it yet because you can see the open interest is zero and the bid ask spread isn't that bad, but the open interest in both the call and the put side is kind of zero. One guy, looks like one person did a trade right here at the $30 strike price on the put side, basically hedging his bet. He bought 2,405 contracts, but otherwise you can see it's a whole bunch of zeros. Let's take a look at the June option. This is the June 60. Okay, there you go. Now, the June option's been around. You can see that there's a lot of open interest. People have been trading it. If you wanted to trade the June option, there would be people to buy and sell with. And so I'd go deep enough in the money, maybe with a $20 or a $25 strike price. You could go ahead and measure how much of the price of the option is actually intrinsic versus extrinsic value. You want to kind of minimize the extrinsic as much as you can. But, yeah, I'd buy probably it looks like I can get for less than half price this $20 strike price option. It looks like it's trading at around $15.42. I could buy that option and it's gonna act just like the stock, but for less than half the price. Again, I wanna make sure I price in the risk, but this is probably the type of leverage I wanna do right now. Then the next step is to wait for this thing to top out. Now, if it shoots to the sky, when it tops out, I'm simply going to sell it and take the profits and run because it's a directional position. But if it kind of just tops out around 38, $39 or even lower, then I'm going to just sell premium against it, buy protection against it, and turn it into one of my income positions that I've been talking about for all these months.
Sure. And I have a question. Since Bank of America is considered a financial company, in a raising interest rate environment, do financial companies tend to perform better than otherwise?
They do, right? And it depends on the individual financial company, of course, how they balance their books, because banks have figured out ways to make money on us in all different ways. It's not as simple as, they they loan out your money, and then they pay you an interest rate, and they loan it for a higher interest rate, and they make money on the spread. That was like banking from, when I was a kid. Now they've got all these different products and heliox and things like this. So they make money in all different ways, especially on penalty fees when people like don't read the fine print and let their account drop below a value. So it does depend on the particular financial institution, but in general, yes. When interest rates go up, they can raise their loan interest rate up, and that spread between the two gets larger. So banks, when the interest rates go up, actually, it's not a fixed amount, right? It's not like whether the interest rate is down at a quarter percent or at 2%. It tends to be more of a sliding scale, and it does tend that banks in general make more money when interest rates are higher.
All right, so we'll definitely keep an eye on this setup. Thank you for bringing that to the attention.
One other thing, Sip, right? When you set up that initial covering position that I'm talking about getting in here, you kind of set up the flavor of the trade, right? And so if Bank of America is positioned well to gain in the long term, buying the stock and or buying a call option that is far out in time and deep in the money that's going to act like the stock is a good buy for not only selling the premium like we do like to do month by month, but also appreciating in the long term on the back end. So we want to figure out when we do these option positions a way to profit on all of it, like month to month and on the back end. And that would be a good way to set this up.